Running a hedge fund is the best way to make money. They make billions of dollars without spending a dime out of their pockets. Even when the market is crashing, even when the stocks are crashing, those guys who run the hedge funds are still making not just millions of dollars, but hundreds of billions of dollars. George Soros, Ray Dalio, Bill Ackman, all of these people who worth tens of billions of dollars made their money by running a hedge fund. But what did they produce? Absolutely nothing. When you look at Apple that manufactures iPhone, Nvidia makes the greatest chips in the world, Tesla builds electrical cars, but what do hedge funds create or build or manufacture? Absolutely nothing. There is not a single service, there is not a single product, and yet they still end up making so much money. So here in this video, let's break down hedge funds and find out how exactly do they make so much money? What is their secret? How do they use debt to make that much money? Maybe by the end of this video, you will have a better understanding of how you can start your own hedge fund. So give this video a thumbs up and let's dive right into it. A hedge fund is a financial institution like any other financial institution. They borrow money from investors and they invest it in the stock market. But unlike you and me who are long-term investors, hedge funds do not invest in the long run. Sometimes they do that, but quite often they're focused on short-term trades. But unlike other financial institutions, they have designed the hedge funds in such a way that no matter what happens to the market, hedge funds should be safe. They should still keep making money. And that's why before they accept your money, they will tell you that they will get a 2% fee no matter what happens. So if I'm taking my $100 million and I'm going to go to a hedge fund and give them to invest my money, they will still take 2% or $2 million annually no matter how much profits they will make on my money. What if the market crashes? What if they lose my money? They still will take 2% out of the total investment that I will give them. Isn't that genius? That's absolutely incredible because you cannot perfectly time the market or predict the market. Yes, in the long run, the market is most likely going to grow, but in the short run, hedge funds are still safe. But God forbid, if they actually turn a profit, if they actually help you to make slightly more than that, they will still take a cut out of the profit that they're earning you, and that is a 20% cut. So if you go to the hedge fund and you invest $10 million and they got you by the end of the year, let's say 10% annually, which is an extra $1 million, they will still take $200,000 out of that extra $10 million they've actually got you. But let me tell you a secret. If you have just $10 million, good luck with hedge funds. Nobody is going to accept you. Hedge funds will only accept you if you have probably at least $100 million. And if you look at their portfolio, they usually manage the money for the top richest people in the world. I'm talking about billionaires. I'm talking people who have actually accumulated generational wealth. But here's the interesting part. This is how hedge funds are actually making so much money. Essentially, there are two ways to make money. When you're actually expecting that a stock is going to grow, you're going to buy low and you're going to sell it at a higher price. That is the logical understanding of how people usually look at the stock market. If you believe that Tesla stock is going to grow, you're going to buy it now. Tomorrow it grows by 50%, you sell it 50% higher, you made a profit. But that's just one way to make money. The second way to make money when the stock is actually growing or falling down is when the stock is going down. This is the Tesla stock. The more the stock fluctuates, the more opportunities it presents to investors to actually make money out of it. The more opportunities it presents to the hedge funds to make money out of it. If you look at the graph of the S&P 500, it doesn't jump much. Maybe it grows by 1% in a day, 0.5%. That's not what we are talking about. We are hedge funds. We should be making much more than that. We are looking into 10%, 20%, and that is the least. We are looking into probably 50, 100%. And when you look at Tesla that grows by 50, 70, 80% within a period of couple of months, that's the kind of stocks that we're talking about. But everybody is making money when the stock is growing. When the stock has grown to its top or it has grown to its peak, hedge funds are going to short that stock. And that means that they're going to borrow that stock from the investors who hold Tesla stocks. For example, let's say that Tesla stock is right now being traded at $400. Now, this is a hypothetical example just to illustrate the point that I'm trying to make. Hedge funds are going to borrow millions, maybe hundreds of millions of Tesla stock at $400 per share. And then they're going to go to the open market and then they will sell it. Now, they made so much money. Let's say, for example, hypothetically, that they have borrowed just 10 stocks in order to make the example much easier. So they borrowed 10 stocks and they sold it immediately in the open market and they made $4,000. A hedge fund has $4,000. Tomorrow, the market crashes and the stock of Tesla is going to go to $200. Now, the hedge fund is going to go to the market right now and is going to buy the exact same stock for $200. And since the hedge fund owes 10 stocks to the investors, it is going to go to the open market and is going to buy 10 Tesla stocks. Each cost $200 and the total amount will be $2,000 and will return these 10 stocks back to the investors, pocketing the difference. They borrowed them when the stock was $400, sold them immediately, pocketed that money, waited for the stock to crash, bought them again and returned them. Isn't that genius? So they haven't actually used their own money. They simply manipulated the market, because when they actually borrowed those stocks from them, they have borrowed them in a form of debt. But the question is that why would anybody do that? You see, in the market, we have long-term investors who are not actually selling their stocks immediately. And mostly their stocks are in a position of their brokers. And brokers are willing to loan these stocks to investors if they want to at a certain fee, at a small percentage of an interest rate. And if investors or hedge funds know for a fact that this stock is going to collapse, they're going to short it. They're going to borrow as much as possible. Because at the end of the day, the hedge fund isn't obligated to return the money. It's obligated to return that stock. And if that stock now is going to cost $200 per stock, then I can simply buy it at $200 and return that stock to the broker or to the investor. Which is why every time you hear about the Tesla stock, you're always hearing about the short sellers, about the hedge funds, because the more volatile the stock is, the more opportunities it presents to the investors or the hedge funds. And that's why whenever you're investing in a stock that is being heavily shorted by the short sellers, that a stock that is being heavily traded by the hedge fund managers, do not be surprised if that stock is going to crash tomorrow. Do not be surprised if that stock is going to go dramatically high. And don't forget the fact that hedge funds also have very deep pockets and they can easily spend millions of dollars, or at least maybe hundreds of thousands of dollars, couple of millions of dollars, in order to promote the idea that this stock is going to grow, to encourage other investors to also buy that stock. It's basically an indirect way to pump and dump a single stock. And if you actually look at the stocks that are being heavily traded in the market, these are the kind of stocks that hedge funds absolutely love. At the top of the list, you have Nvidia, you have Intel, you have Tesla, of course. Without Tesla, it's impossible. Palantir. And I bet you, if you look at the Palantir stock right now, you will see that its entire history, it has been going up and down, exactly like a roller coaster. So if you're a long-term investor, you should understand how hedge funds are playing around with these stocks and don't let yourself to be emotional when you're investing. I'm a long-term investor. I'm not actually getting emotional when I see stocks jumping up and down every single day, because I know that the games that hedge funds are playing, I know that hedge funds are making a lot of money out of it. So when you see that the stock price, for example, of Tesla has crashed for around $500 over here to as little as $230, let me tell you something. Hedge funds made $16 billion in the last 3 months shorting Tesla stock. Now, another stock or another commodity I would say that hedge funds like a lot is oil, because oil is one of the most volatile commodities in the market and it's very heavily traded. One day it's being traded at $200, the next day it's traded at $120, it can go as low as $20, $30. And if you remember, back in 2020, oil was even being traded at something around like negative $20 if I'm not mistaken. How do these hedge funds know that this stock or this commodity is going to rise? Now, if you have a very big, great team who can analyze the entire world and analyze a certain commodity, you can make certain predictions. For example, we have a company that is going to release its earnings the next day or maybe next week. And we believe that Tesla is going to meet its expectations of investors at their revenue target. So if they're going to meet the revenue target, then there is going to be more confidence by investors in Tesla, and they will buy more Tesla stock, rising the price of Tesla stock. So we are going to buy it before that happens. Vice versa, if a hedge fund believes that Tesla is not going to hit its annual targets revenue for this particular quarter, then they are going to short it. And when they release their financial statements and find out that they haven't actually achieved their targets, then the stock is going to go down and the hedge fund is actually made money out of it. And the hedge fund profited out of the fall of the stock. Or another example could be that a hedge fund analyzes a particular stock and they find out that it is a very overvalued hype stock, like Palantir is right now, like Tesla has been in the last couple of months, or probably in the last year or so. But here is the best part. Here is the most interesting part of what hedge funds usually do. They drive companies into bankruptcies and they make billions of dollars out of it. And if you're wondering how is that even possible, how do you even drive a company into bankruptcy and still manage to make so much money? Well, let me give you an example and illustrate to you how exactly that is being done. For the sake of simplification, I'm going to get an example of GameStop. Remember back in the days when everybody was talking about GameStop, it was 2020 and 2021. Now, this is not exactly what happened with GameStop, but I'm going to just use the example of GameStop to illustrate the entire point of how hedge funds destroy companies and make so much money out of them. GameStop, like any other company, raises money in order to grow its business, which is absolutely normal for any business. And the way they do that is through, for example, corporate bonds, or they can do that by directly going to the bank and getting a loan, for example. So we have on one side who are lending money in form of corporate bonds or loans from the banks, and that money goes directly into GameStop for them to develop new products, pay for their salaries, and that's a very normal thing in the corporate world. Every single company that you see in the stock market or anywhere pretty much has some form of debt, especially if that company is being traded in the stock market. It means that that company is so huge that they have the ability to raise billions of dollars. So often, if they expect that they will make a lot of money in the future, they will raise some kind of a debt to invest in a factory to mass produce their products and sell it much more and make a lot of money and simply pay back their loans. That is an absolutely normal practice in the world of finance. And this is how hedge funds use that. Hedge funds are going to go and are going to buy all of the debts of this particular company. If these bonds are in the form of corporate bonds, then they can easily go to the open market and buy corporate bonds. Just like you can go and buy US government bonds, you can go to the open market and buy corporate bonds of any corporations that are selling them right now. So a hedge fund is going to buy all of the corporate bonds of this particular company, which we have called GameStop. And then hedge funds are going to go to any kind of a major financial institution such as JP Morgan to ensure that this debt is not going to collapse. And they will buy something called credit default swaps. Now, in simple form is that if I've actually bought so many corporate bonds of this particular company and I'm worried that this company could potentially collapse in the foreseeable future, so I'm going to go and insure it. So financial institutions, especially huge financial institutions, I'm talking about JP Morgan size, I'm talking about BlackRock size, they provide insurance on debt. That means that I can buy insurance on this particular debt. I will pay some kind of a fee to JP Morgan because they're insuring my debt. But if this company from whom I borrowed this money is going to go bankrupt, they will not be able to pay my debt. Who is going to pay my debt? Exactly, JP Morgan, who has insured my debt. Since our debt right now is being secured by a large financial institution, now we are going to go and destroy GameStop and make billions of dollars. Here's what we do. There are plenty of investors that GameStop has, and we are going to go and massively short that stock. Let's say, for example, hypothetically that the price of GameStop shares right now are $10. So we're going to go and borrow those stocks at $10 each. We're going to borrow as much as we can. Sometimes those corporations or those hedge funds can borrow literally 100% of all the stocks that exist in the market. Now we're massively dumping these stocks in the market and selling them. we are selling them at $10 each, and we have to return those stocks back to the investors from whom we actually borrowed those stocks. But because we are massively selling those stocks in the market, and because this is a small company, it's not as big as Apple, we have massive influence over it. The stock price goes dramatically down because on one side everybody is selling, on the other side there are not many people who are buying the GameStop shares. At the same time, we're going to spend millions of dollars in ad campaign in order to spread the news that GameStop in such a bad position that this company is going to default. And you as an investor in GameStop, you're going to panic and you will pull out your phone and you're going to sell your stocks in GameStop because you don't want to lose your money. The stock is already going down. We're going to create panic within the entire market. We're going to pay the reporters. We're going to pay the media to spread that news. We're going to use every resource that you can possibly have in order to spread panic about this company, and the stock goes down and down and down. And when the stock, for example, reaches, let's say, $1, we're going to buy the exact amount of shares at $1 each and return them back to investors. We don't owe the investors a particular amount of money. We owe investors at a particular number of GameStop shares. Yes, when we borrowed them, the price of GameStop was $10, but today they're worth $1. It's not our problem. That forces these investors to dump their GameStop shares as well because they see no point in their shares and they're expecting the company to go bankrupt. And when everybody has sold their stocks, the stock goes into absolute zero. Remember, a company has a lot of debt on the other side, and they have to consistently raise money to pay off their older debts. That's how most of the corporations work in the world. And because their stock is at $0 right now, not a single investor is going to buy their debt. Now the question is that who is holding most of their debts? Most of their debts are being held by the hedge fund. And now this company cannot pay hedge fund, and this financial institution has to pay the hedge fund all of the debt that they have borrowed because they have actually insured their debt through this company. Let's call it JP Morgan. So GameStop goes bankrupt, hedge fund gets their money back after buying massive amounts of their debts, and they make billions of dollars by shorting the stock. This is probably one of the nastiest ways hedge funds make money. So whenever you see a hedge fund and they target a particular stock, usually they do their own research. Usually they try to look for a company that is already weak. Usually they try to find a company that has a lot of weaknesses and chances of it going bankrupt is extremely high or probably higher than other companies. And then they are going to use their resources and their millions of dollars to drive it out of the business. And all of this was made using debt. The better you understand how these hedge funds work, the more you understand the market, and the less likely you're going to make the mistakes that these hedge funds want you to make. Because sometimes they literally manipulate the market for you to buy a particular stock or to sell a particular stock. And if you want to get really good at the stock market, you want to really know all of these games, you want to really know how everything works and become a professional great investor, then check out the description of this video. That's it for today. Thanks guys for watching, and I will see you in the next one.